Okay. Order blocks, fair value gaps. We are going to do that in the opposite order that I just said them, using your question specifically. Why that particular pattern represents a fair value gap. So, a fair value gap is going to be just the name that we're using to characterize this repeating pattern, essentially. The defining characteristic. Some examples. Defining characteristic is literally just this. It is a gap in between this candle high, this candle low, or this candle low, this candle high. Even if this was like right here, there's still a 2 point fair value gap there. And as the name implies, fair value gap. So it's a gap. As I said, it is a inefficiency. A lot of the stuff we're going to be looking at, you could call them inefficiencies. This is an inefficient delivery of price to the upside or to buy side. So what does that mean? That means that we did not give a fair opportunity on both sides for price. Price came up, but we did not. So here, if price was like this, if this is what the wicks look like, this is a efficient delivery of price lower. Now, I'm using these words efficient, inefficient because those are just the words that are used in these contexts, but don't take efficient for all of its synonyms. When I say efficient and you would be in a sell trade here, you don't this isn't a good thing. This isn't always a good thing. Let me say that. Let's say that. When we leave, so a fair value gap is just the basic primitive this is a fair value gap. When you say why that pattern represents a fair value gap, it just does. It's called a fair value gap because it is a gap in the fair value of price. So for fair value, you would need an efficient delivery, which means you need an opportunity on both sides, essentially, for price to be delivered. So why this isn't, so this would become then a mitigated fair value gap if we say, literally we did this, and then right after, say we did this. Say here we came down, and like imagine these are price action. I'm not drawing all the candles. We came down, and then we did this. Now this has been closed beneath. This fair value gap is mitigated. So now, if I say something like when we have a fair value gap like this, we're looking for a price to essentially do this, come back down here, and like go higher. If I say we're looking for price to do that, that doesn't mean like you're putting, because this is what I was doing legit like probably 12 months ago. When you watch one ICT video, you're like, oh yeah, you just buy fair value gaps. This is not what we're doing. We're not just taking an entry on a fair value gap because we expect it to bounce. It's not we expect it to bounce. It's if we bounce, then we know, okay, if we bounce, then we know that the narrative is most likely that we are going to be bullish to probably at least this high, this intermediate term high, this most recent high. So if we were to have a fair value gap somewhere here in this move up, and then we had a return to this before we hit this high, especially, we would be that would be a possible better trade. This is That would technically be the ICT 2022 model. Assuming that this low took out a low here. That's the ICT 2022 model. It's this, and then that. And you look for a fair value gap. Technically, it can be like this. And you look for a fair value gap like here once we come past this. But sometimes like this intermediate, this like high, where we come down, we take a low, we come up and make a high, we take this most recent low. Sometimes this will be like this. Like this can vary sometimes. But the setup is technically once we pass this, you look for a fair value gap up here or a return to a fair value gap right below it. I mean, what else can I say about fair value gaps? We use a lot of different kinds of fair value gaps. And so as I said, we're not just buying fair value gaps because there's so many fair value gaps. Like when we're going to look here and we're going to look at today's price action, there are going to be, on the 1 minute chart, there's going to be probably, I'd say, 500 fair value gaps maybe. Right here. Bearish fair value gap. It's a gap in these candles. There's one. And we're not counting. But here's a bearish fair value gap that we immediately, though, came and closed above. So we re-delivered price. So this is now a balanced price range. Price has been delivered to the sell side and to the buy side. So this is a balanced price range. And then we come back below it. We came up on this wick, tapped into it, and we sell off at open. Right here, bearish fair value gap we came back into. So I'll say this too, I guess might as well in this video. I already told Ben a little bit about this. You have to think, so you have to be looking at these markets from the perspective and the belief, assuming that it's going to be algorithmic and it's going to be predictable isn't the word I would like to use, but it's all I'm gonna have as an option in my head. We'll say predictable. Assuming that it's gonna be repeatable setups, repeatable concepts, repeatable patterns you recognize, repeatable things, because it's not a pattern, but it's a thing in the market. So like this right here, this is what I was looking for one of you guys to see. This is hard for you to see, of course. Ben, I thought maybe had a chance because I had just given him that specifically last night, and this was near the end of the video for you maybe, but this was our low from the 7 to 8:30 a.m. time cycle, 90-minute time cycle. Also the low from the previous 30 minutes. So for building our narrative here, we came back up into that low, which I guess we'll do a little 2-for-1 right now. Technically, this... Okay, let me say this. Order blocks are way less strict than fair value gaps. Order blocks are like very, how do I say? Order blocks are situational. I that's how I'd say it, I guess. To be fair, the only way I've seen ICT describe an order block is, I'll give you that definition. This candle, this is an order block. This green candle. A up candle in a downwards move is an order block. Down candles in an upwards move is an order block. So now, how would you use those order blocks? Right here. This first, or, okay, this is how I've seen other people describe it. Other profitable, good traders, but not ICT himself. The last green candle before a downwards move, or the first black candle before the last black candle before a upwards move. So this could be an order block. And what do you look at for an order block? You're typically looking at the open price of the candle. That's what you pretty much always look at the open price of an order block. That's what like order blocks are considered. based on, pretty much. We had a decent one that I saw, but then I missed it. So yeah, you can see here, it's a little hard to see with my box lines, but this 830 candle actually comes the whole way up here and the whole way down here. It's not just like this small. That's the wick right there. So I will say this. I don't know what ICT calls it, if he calls it order blocks or not, but when you have a wick exactly like this, when you have a wick, you need to look at the wick. So I'll say order block. Order blocks are literally, it's a place where there's going to be orders resting in the market. That's how you have to think about it. So using that exact logic, when we have this green candle, why would there be orders resting there? Well, okay, if you're going to think about it from a like retail perspective, you have to think about it, okay, we're in a down move and we get a green candle. There are people who are going to buy just because we have a green candle. That they think we have a reversal now because we have a green candle. And the same would be true in a upwards move with it's a reversal. Enter your shorts here. So then when we go down and we come back up to it, you can see this open price here. We came back up and tapped it. Now obviously here we have these next three candles that we can see. And again, order blocks, none of these never alone are you using one thing to take entries on. So like I can point this out that we came to this 7 a.m. low, this 8:24 low, but 7 to 8:30 a.m. low, and went lower off of it. I wouldn't still though. This isn't like this. This could be a setup, but this isn't like my entry model or something though. So I'm not taking that trade. Now, if you wanted to take that trade, how would you be able to frame that trade reasonably? Okay, I did not realize the wick went that far down as well though. That is lovely. I will say, actually would consider that trade because of this wick. This wick is 8:30 a.m. news, and data highs and lows are a pretty significant level to target. So like that wouldn't be a terrible. That would play out pretty often. That if you see something like this, we're probably going to come for this low before we're going to close back above this high. I would bet that works out probability wise at least 70% of the time, maybe. But yeah, so I mean, let's see if we can find a good order block example. Okay, that was the one that I saw, but I don't know why I kind of forgot it. I like to annotate order blocks with just a trend line, and then you throw that on. So this is a green candle, and by the way, the order block is both of these candles because they're two consecutive ones. It's both together is the full order block. Upwards candles and a downwards move. So we can see how we make a fair value gap here with an order block inside of it, which I will say is a very good combination. It's a very good parlay of period arrays. And period arrays or any ICT entry technique. It's a very good combination, confluence between the two. It works quite often. We have the open of this candle, and you can see just how we come up here and we tap it, and then you can see how we deliver or push lower off of that. And we use the word deliver quite frequently because you have to think about it from an algorithmic context. It's not buying pressure, selling pressure. Buyers are pushing price up here to this level, and then the sellers take control and push that lower. Like it's just you don't get the level of precision that you get with ICT stuff. The bodies here perfectly respecting this. I will say sometimes the bodies will go over. That's just a volume kind of thing. Sometimes when there's a lot of volume in the markets, especially on an asset like NQ that moves so quickly, we're moving 60 points in like 6-7 minutes. It goes over a little bit sometimes, so you have to allow for a little bit over. And you also have to allow for the wicks, because the wicks are what's going to stop you out. Those people who are even ICT traders who are inexperienced, who are taking these shorts, who have their stop loss a centimeter above this fair value gap, they're getting stopped out here, and then we're going to move lower. The primary goal of ICT, by the way, is just the basic thing you can think about ICT is who's making money, where are their stop losses, and then using that, you look at the entry techniques and how you're going to be trying to get in. So like when you look at this here, when we look at London session, we have all these highs, but what did we not really do? We did it here. We didn't do it. We didn't take out these lows, this low, this low. We just kept taking the high. And I will also mention that's 8 a.m. right there, 8 a.m. high a day. Remember, time's always very important. 8 a.m. high a day. And then we drop from there. And you have to use these things such as fair value gaps, order blocks, to build your narrative so that you can understand, you can be on the right side of the market. So like, we're not taking a trade here on these closes. The trade's down here on the disrespecting this fair value gap. When you disrespect this fair value gap, this is literally Dodgy's exact setup. You disrespect this fair value gap. We're trading off of another fair value gap. And as soon as you go below this low, you move your stop to break even. And then for me, I was just targeting a hourly low inside of a fair value gap right here. No. I think was it this one? Yeah. This was my first target. This swing low on the hourly chart. And then later in the day for the afternoon for my second trade was, this is a ITH, call it an intermediate term high. It is a intermediate term high, or ITL, intermediate term low. This is a low or high that is formed inside of the fair value gap. So that would be this one. And this box that I have drawn is just is the unfilled gap part of that fair value gap. What's still remains to be filled. So like, yeah, you would use fair value gaps essentially on the 1 hour, 4 hour, 15-minute time frame to help you build your narrative. And you can use fair value gaps in past tense to build your narrative as well. So we can see right here, we are still delivering off this fair value gap. We did not come and close below this fair value gap. So we can expect that, into next week, we might bounce here. And where are we going to come back up to? Who knows? And you'll also see I have this hourly wick consequent encroachment marked out because that was my in-between target between this low and here. And we can see when we got to that level, did we reverse super high? No, but we did hit that and then reverse a bit before we continued lower. So like and then we came back up again, 4 o'clock, and tapped it. So these things are all things that are worth having on your chart. And like the more drawings that I hide my drawings, and you're like, okay, well now you have a little bit less to look at. We don't have the fair value gap down here. We don't have that. You start hiding indicators, and you're back to just this. And when you're at just this, you still have to be able to see though. Okay, we have a fair value gap right here. We came back up, traded into that there. Sure. We have data lows right here that we came up and we took out, continuing lower off those. You have to be able to go to the 1 hour. You have to be able to go and see. Okay, we have this low that okay, you have to think about it like this. When we are 8 a.m. candle, when we're right here, we're just right here. Imagine you get on your charts, you're seeing this. This is 7 a.m., but still. You get on your charts, you're seeing this. We have a fair value gap right here, but if we look to the right there, we closed below this already. So that tells us we're not respecting this fair value gap. And when you look here, there's no other fair value gaps. This is a balanced price range. I'm going to bet if we go to the 4 hour, it's going to be the same. Yes, we have a fair value gap the whole way up here, but it's a balanced price range other than that. So with that being said, where can we expect to go? should we bounce here and go higher? Why would we? We have no reason to bounce here and go higher. That's one thing I saw today in Dodgy's Discord. I was DMing some bulls last night and this morning. Bulls were saying we have data highs because Dodgy he does sell it a lot. That the data highs are like all in essentially type shit to go for. Like he calls it just one setup for life because it's a good setup for sure. When we have data highs or data lows, they're a very good draw on price. Price will tend to go to them more often than not. So people after but the problem with that is then when you give someone an inexperienced trader, you say something like that to them, like data highs are a good draw or on liquidity. They can only take a trade to the data highs then. I think I literally saw someone take this trade. They're taking this inverse right here. First off, we're not delivering off anything here. Maybe no London low. Pop on the hourly. Just because I want to give them a fair chance. We're literally like, that's one thing too. You don't use really order blocks you don't use order blocks unless it's in past tense on the hourly, on the higher time frame charts. I'd say that. You use wicks for sure because the wicks, as you saw with this 50% one, the wicks shit happens around there. We have some reactivity around there. But other than that, the order blocks, I mean, let me see if anything. Let's look on a higher time frame. There's too many candles here. No, I'm not seeing anything really order block wise. I will say that's a beautiful short too. When was this? 10 a.m. Wednesday. Would be, yeah, Wednesday. When you see this, I just fixed my computer, so I haven't been able to trade every day. Let's hide those drawings again. Okay. Getting back into the flow of actually being on charts, but these are some beautiful lows. So you have to think of retail perspective. You see these lows. What are we thinking? Resistance. It's going to go higher when we come back down here a third time. We come back down here a third time, and we dropped 300 points below it. So when Wednesday we close and we open Thursday, and then this is the 10 a.m. candle that comes and takes this out with displacement. You love to see this, to be honest, on Thursday. But then Friday, this is what we have. Friday, okay, knowing what we did the start of this week, kind of just consolidated all-time highs, didn't push higher. To be fair, we can see literally right here. What did we do up here? We pushed lower off of this fair value gap. Now that orange gap, again, orange gap is killer, man. That orange gap right there. People ain't having these on their charts. You're just literally losing free money. Pink gap is the first fair value gap of the day, each day. That's what the pink gap is. Right here, on Monday, you draw it out across the whole week. And look what we did on Wednesday. On Wednesday, that was the high of day on Wednesday. And look at the time as well, 2 p.m. That could be a trade, I'll be honest. 2 p.m. coming into this gap, you get a green candle right here, and then once you get this candle back down, especially even here closing below the range back down, I would probably take that. I like this candle too, closing below this small fair value gap. I wouldn't be against that. Or even here, closing below this slightly bigger, better fair value gap, and then you get a nice lower off that. Here you go, 2:13 p.m. order block right here. Come back up into it, just a wick, tap it, push even lower, take out this 119 low. I'm just mentioning these things. These are what I'm looking at. Look at that. Wick down. This is an order block, and so it's when you have like a low with a long wick, you draw it on like the bottom of the wick. Obviously, it's gonna be on the wick either way, but like Here, this high, this isn't really as relative. If we had a wick high up here, we draw our 25%, 50%, 75% levels on the wick. And when we come back up, we expect some reaction possibly at the wick, and we could reverse off the wick, like the 50%, 20% level of the wick. That's why we draw these levels. So like this one, I mean, this one, you can kind of look at it too. It's not, again, it's a slightly deeper dig in. And then you look at that, you're like, okay, why don't we just tap this perfectly? Well, I mean, we do have this fair value gap right here that we're also trading off of. And we're also almost tapping the 50% level of this yellow box, which we can save that for another day because we ain't gonna have time for that. But like, yeah, you can see it. You can't deny that this there's a reaction at this fair value gap, because if you were saying it's at the previous day high, well, why did we go this much above it, and why did we stop here? Why don't we go higher? That's kind of the logic there, in my opinion. I mean, and you can literally see here, this is 3 p.m. This is the fair value gap from 9:40 a.m. When you draw it out, did we respect it perfectly here? No. Did we respect it perfectly here? Pretty much. Bodies are respecting it. We came, and it's like, okay, if you're going up here and you're saying, well, it's a bullish fair value gap here, right? Then we close below it, so now it's a bearish fair value gap. It's a bearish IFVG inversion fair value gap. An inversion fair value gap is when you have this, then we close below it, it becomes an inversion fair value gap. So now we're looking for a sell. So these are this sell opportunity. These 3 entries, so this would be possible sells you could take. I will say here, you want to see this hit the daily low. I'm pretty sure though, again, we're gonna have to talk about this another day. This was an SMT, I believe, this low. So that's just something that you have to have kind of the experience with, and you have to know and have that chart up of the S&P 500 at the same time, and you'd be good. And SMT is a smart money. I actually don't know what T stands for, but it's when you have at the same exact time one indice makes a low or a high when the other one doesn't. So an SMT would be if we had like a high right there, and then we did this and we did this, and then we had a high right here, and then we did this. An SMT is when, say this is NQ, this is what happened right here. We didn't take this key level, but on the S&P 500 we did take this level, then we can consider that the same as taking that level on NQ. It doesn't have to hit it on NQ as well. It hits it on like one of them, essentially. It counts for both. And SMTs are also SMTs are purposefully done. They're a sign of manipulation. Typically, SMTs will provide you good setups. When you get SMT, you typically have good delivery based on it, essentially. So like, this is sloppy price action, but we got that a lot this week in the morning sessions. It was we had news, but it was a weird news week, which I'm guessing is just based off of the election. We did not move as much as we should have off the news. Typically news candles will be like 100 points, but our news candles have been like 50, if that, 60 points. So I mean, let's see. I think I explained fair delivery and price enough. Yeah, we're not looking at anything to do with bid or ask prices. You can see, okay, well, we have a spread right now, but that's literally, we have a $25 spread, but that's because we're in, it's 11 p.m. and we are in Asia session, I think. Oh, no. We have a 25-point spread because the market's closed and it's the weekend. That's why we have a 25-point spread. During the day, well, you're legit 25, 50-cent spread max. So, not that is the reasoning, though, why we don't look at difference in bid asks and sellers it's we just don't look at that in general. It's not something that influences the market. We're looking at that type of thing to help us build our narrative. That's how. Let me see if I can find a good trade here. Specifically, something Doji takes trades on a lot of the time, and ICT will mention is LRLR. LRLR is a low resistance liquidity run. So what's a low resistance liquidity run? A low resistance liquidity run is when we build. Literally, this day was perfect. Perfect. First off, let's build it here. 1 p.m. low. 107. Come back down, but we don't take out the low fully. Okay. Let's continue building here. We have the first opening gap above. We could, look for a return to that. But again, those are terminus targets. Those are final targets for runners. You're taking partials before then. Here we go. LRLR is this. So when we have a trend line like this that price is respecting, we can see like how you quantify that algorithmically when price is taking lows without taking highs, when we're having lower highs essentially. You don't know when it's going to break, but how do you kind of not predict when it's going to break, but be on the right side for when it's going to break? Technically, you could have a dodgy entry right here, and believe it or not, this is actually a break-even trade. Because again, with LRLR, you're just looking for your final would be here, but you always take partials at internal highs. This would be a break even though. Let me say that because you enter on this candle close, and as soon as we hit this high or even this high, either of the highs, you move your stop to break even. So then 2 candles later, it's just a break even trade, and that's a trade where you almost expect it to hit break even, but you still take it because sometimes it won't hit break even. But it's a trade where it's like a 95% chance that you're going to hit break even, just based on the probabilities of disrespecting this bearish gap, that we should hit this internal high, before going lower. That's why it's such a high chance at break even. You don't take contracts off the table and take profit here because it was literally 2 or 3 points. So you would then be decreasing all your future winners by trying to take profit. It's such a low, so you don't take profit, but you for sure take money off the table. So then again, here we're looking at this obvious fair value gap right here. The obvious ones are the ones that Doji takes. Obvious gap. This isn't an A+ setup, but actually, to be honest, this isn't a setup you could take at all. You might be able to take this on the 30-second, but let's assuming you take this just on a re-entry to this now IFVG bullish fair value gap. Right here on the re-entry, you take that and low resistance liquidity run is this. It just goes up, it just takes this high, comes up, just takes this high, comes up, takes this high, comes up, just takes this high. That's a low resistance liquidity run. This move right here is like a low resistance liquidity run to the downside. What's a high resistance liquidity run, you might ask? This to the buy side. Do you want to be in this? You are stressing if you're in this and you're in a buy. Going up 40 points, going down 50 points, up, down, up, down. That's a high resistance liquidity run. This right here, come back up to it, drop. That's a low resistance liquidity run to the sell side. So you want to be you have to trade both conditions though, but that is something to note, that there are those the difference in conditions. This is an interesting one. I think I did put this in something, but this is a good one to study. Maybe I'll go over what I can here quickly live. But I get this Jake Paul fight on. Gotta watch this for sure. All right, let's look at it here. So we have a 830 candle right here, which I didn't annotate, but I will now. That's what I'm seeing when we come up here after open right here, 9:30 a.m. We open. I'm also seeing, though, we have this gray box. Again, we're going to have to talk about what that is another time. We come up, bodies are closing, respecting it. Okay, I'm thinking in my head, all right, we're probably gonna be bearish here. Probably gonna go down. Okay, sure. Probably gonna go down. Ooh, I'm not sure what this is. Where'd that come from? Oh, I think this was because I was framing this trade. I was looking at an entry to this fair value gap based off this candle coming up, and oh yeah. I was like, because of how crazy the RR would be here. Because I'll also say this for framing the sells. Look at this. This again. Look how this plays out day in, day out. What did we just look at? We just looked at today, Friday, yesterday as well. The 8 a.m. exactly low, but the low between 7 a.m. and 8:30. You draw it out. The candles come up into it, and then go lower off of it. Now, do they go lower and take out this low before taking out their own like intermediate term high? No, but this is enough points. That's 30, 40 points there. You could be a millionaire on 30, 40 points for sure. Right here, though, we come up, when you respect this, you're like, okay, we probably are bearish if we're doing that. That's a sign. But then here we close below this opening gap with momentum, because this is a very large candle, and then we kind of match it and close below. That's where then you take your sell there. And I was just targeting the London low here. That's that trade. So this order block, ICT calls it a breaker block. A breaker block is when it's literally when you do this. This can go wherever. This doesn't matter. This is a breaker block. So when you have a high, then you make a low, then you make a high that's higher than this high. This swing low will have a breaker block on it. And what you can look for when price goes below that, you can look for it to come back up into it to trade then lower off of it. This is actually the ICT unicorn setup. When we have a fair value gap right here that lines up with the breaker, it's the unicorn setup. That's what it's called. Which we actually do have literally right here. So this is a breaker block. And right here we have a fair value gap, which technically this candle also made this would be the unicorn setup. Because after we take out this London low here, we might not, again, come here and then even go lower, which we did, but it wasn't low resistance. You can see that. This is not low resistance price action. And then, okay, so here we have a nice fair value gap, clear, obvious. Here, it's not really the best buy, in my opinion, for an inverse. It's already so high above. Now, it worked, and you wouldn't have got stopped out, and it would have been a trade that you can take. Let me say that. If you entered here, it just would have been some drawdown, 30 points of drawdown about. Because the stop out on this is if we reclose again, if we close below this fair value gap, then you stop out. And I mean your target here though, I don't even know. You probably TP like here, I think. You TP at this in fair value gap high, and you can look at this too, 50% level of that breaker. That would be your first TP. There we go. There's that. This this was just me. This was a quant view. That's not a trade you would take, but so this is a scenario where you have to be like ICT to enter here. This is the midnight open and the 9:30 open. Each of these lines are those. You can see here how we act at those levels. We kind of treat it as resistance and go lower off of them. We react at those levels. Fair value gap here, just framing this. Again, here, we close above, and you're not taking a buy here because you're not delivering off anything. There's no fair value gap that this low is going into. This is just going up and then going lower. We actually come, you can see order block right here, this green candle, order block. Frame it so you're not slightly less confused, maybe, hopefully. Order block right there. We came into, we go lower. Even though we did that, and we cut around right here, and I liked this. One, the time, 1250, key time. Remember that, 1250 to 110, key time. We had just taken out this low. And the time of the reversal. Clear fair value gap. We invert it, enter on the inverse. This probably, to be honest, is a break-even trade. Maybe 70. You scale a little bit. You scale right here. 25%, 30%. So you make a little bit of profit. But to look up here, even though we closed above it here and we disrespected it, we still used it here to go lower. So it's like we're always referencing these things and the continued use of them. Right here, bullish fair value gap. We come up, we act like we're going to go higher off of it, and then we drop below, close below. Once you get to close below, that's money right there. This would have been a nice one, because right here is your break-even point when you hit this. So right here, we get to here, you hit break-even, and you're looking for, this low. But again, it's not always going to get hit. So like this is a 61 point target, and you have to look at this 157. When you see this green candle and it's 158, you probably trail your stop loss, to be honest. I wouldn't be too confident in that trade at the time. You enter at 150, so that's when there's no spot for a reversal here at 150. But after this at 2, then you get a little worried. You start to get a little questioned a little bit, maybe. We come back up literally to this again that we used here, and we inverted here. We came back up, we tapped that 50%. We use it here. The bodies aren't even closing inside of it. We came up, we tapped it here again. We came up, we tapped it here before selling off near the end of the day. And yeah, this was just this I was struggling. I think I was in a voice call with Ben. And I was just messaging this guy in the Discord because he was saying like, first, it's funny because I have to say it. This bull said that we had 2 p.m. news, which isn't. I don't know if it was right or wrong in itself because I didn't look at if we had news then. 2 p.m. news, sure, whatever. He said he was taking a trade here, targeting the data high from the 2 p.m. news. Now, like, you don't need to even know shit about trading to know that this 2 p.m. candle does not have a high in it. Like, yes, it has a high, but like, this is a high, 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 this is a high. This ain't no high, bro. This is just a normal ass candle. And he took this trade too. So that's the thing. Like, these bulls take it too literally. Now, this technically, I don't think Dodgy would have taken this trade. One, because I mean, we barely take this time-wise, too. You don't trade last hour of market open. It's just not good price action normally and not good volume. And sometimes, even if everything could line up correctly and it could be your trading plan, and it could be your model, it could be everything, it could just go the opposite direction because it just sometimes does that. Because it's not conditions to be trading in. That's just how it works. I mean, I will say, again, another one here that we can see. And I will say, though, even in these conditions, it's still algorithmically acting, though. Tap that, go lower, take out this low, then go slightly higher. Come back here, and then off here we go lower. Right here we come higher. Where we come higher to become tap in about the 50% level of that gap, I'd say. And then we go lower for the end of the day, and then we eventually close. So, like, yeah, I think hopefully this might have helped a bit, maybe. But
Let's see what that was. I'm going to go 28 minutes.